If your strategy relies on finding a stranger with a 1,000% return and blindly clicking copy, you are setting your money on fire. We have to separate social trading from true copy trading. Social trading is a community where people share ideas, but you still pull the trigger manually. True copy trading authorizes a specific algorithm to execute someone else's entries, exits, and stop losses in your account automatically. Institutional AI systems now dominate the majority of trade volume, while global financial regulators are tightening the rules on how trading signals can be advertised and executed. To navigate these changes, you have to abandon the gambler mindset and actively engineer a three-pillar system designed to protect and grow your capital. The first pillar is the platform itself. A slick interface and a fast mobile app mean absolutely nothing if the underlying security infrastructure is weak. You need Tier 1 regulatory compliance, such as oversight from the FCA or SISAC. The FCA is the Financial Conduct Authority in the UK, and SISAC is the Cyprus Securities and Exchange Commission, enforcing strict financial standards. This oversight ensures your funds are kept in segregated accounts, entirely separate from the broker's operational money and locked down with two-factor authentication. You also need to verify exactly how the platform and the signal providers make their money, ensuring no hidden spreads slowly drain your account. Alongside clear fees, the platform must offer a wide diversity of assets, like Forex, commodities, and crypto, so you aren't forced to rely on a single market. If you ignore this foundation, it doesn't matter if you find a successful trader. Their profits cannot protect your funds from a systemic platform collapse or aggressive fee erosion. The second pillar is how you vet the traders you plan to copy. The biggest mistake you can make is picking a provider just because they sit at the top of a leaderboard after a highly profitable but volatile 30-day run. This is a diagram showing two distinct trading styles plotted over time. A trader who takes massive risks might show huge upward spikes, but those are followed by sharp drops. What you actually want to see is a smooth, steady upward slope, indicating a highly consistent strategy. To measure this risk, you look at maximum drawdown. Maximum drawdown is the largest percentage drop an account has experienced from its highest peak down to its lowest trough. A trader with high returns but a 50% drawdown means you have to be willing to watch half your investment disappear at any given moment. Next, we apply the Sharpe ratio. The Sharpe ratio is a mathematical metric that measures a portfolio's return relative to the amount of risk taken to achieve those returns. A ratio above 1.0 tells you that the trader is actually being compensated for the risks they are taking, rather than just getting lucky. You also have to dig into their average win compared to their average loss. A 70% win rate looks great on paper, but if their losing trades are 5 times larger than their winning trades, one bad day will wipe out weeks of steady gains. Rigorously applying these specific performance metrics is the only reliable way to filter out reckless traders and protect your portfolio from unexpected blowups. The third and final pillar is internal risk management. Copy trading is a tool, but you are still the portfolio manager, and you should never grant a copy trader unchecked access to your capital. The first rule of safety controls is fixed allocation. You must dedicate only a specific, strictly capped percentage of your total account balance to any single provider, walling off the rest of your funds. This diagram shows a capital balance equipped with a portfolio stop loss. This acts as an automatic eject button. If the copy trader changes behavior and hits your loss limit, the system severs the connection and closes all positions instantly. To further smooth out volatility, you split that capital across 3 to 5 different providers who trade entirely non-correlated strategies. If one trader is experiencing a drawdown in major Forex pairs, another specializing in indices or commodities might be seeing steady gains. Implementing these hard safety limits takes copy trading from a passive gamble and turns it into an actively defended investment strategy. Looking ahead, these tools are becoming more intelligent. Artificial intelligence will actively monitor a provider's psychological behavior in real time, instantly flagging sudden increases in their trading volatility. This is a diagram showing how these AI systems will operate as automated advisors. When the system detects a failing strategy, it dynamically shifts your capital away from that unstable trader and rebalances your funds into the more consistent nodes of your portfolio. Deploying this level of automated capital routing requires a massive amount of technical trust, which is why it will only be safely supported by platforms operating under top-tier regulatory scrutiny. Building a resilient system means combining these upcoming AI-driven technologies with strict, unyielding risk management. Take control of your copy trading strategy and start building your 2026 architecture using FXNX's institutional-grade platform today.